Hi, this is Tim Kerrin from Mortgage Choice in Kingsley. I'm the owner manager here. I wanted to talk today about what's been going on with interest rates recently. There's been a lot of talk about what's happening in the market with interest rates having reached their lowest point ever in the history of Australia, and then starting to increase more recently. So I just wanted to talk about the fact that that's happening and what I think it means. Up until a few weeks ago, we'd seen some of the lowest fixed rates ever, and I think 3.69% for 3 years is probably the best deal I can think of that doesn't exist anymore. And yeah, since then, loans have started to go up. The thing to appreciate in this context is that fixed rate money and variable rate money come from different places. So pricing can happen and interest rate changes can happen for a variety of different reasons. For example, a lender might get hold of a tranche of 1 year fixed rate money for a particular price, add a particular margin on, and then sell it to customers. Then separately, they might get a 2 year fixed rate tranche of money at a different price, add a margin onto that, and sell it to customers, which is different again to where they get variable money from. But yeah, that cost of funding is part of the reason why you get charged a break cost when you break a fixed rate loan. The lender is paying a particular price for that money, and if you pay it out too early, then that affects them. As of right now, fixed rates have gone up in the last few weeks. I think that's mainly because lenders have been getting money from different places in terms of fixed rates, and as far as variable rates are concerned, they've been jostling for position in the market, trying to figure out how low they need to go to compete for business. The fact is that the vast majority of home loan lending that happens in Australia is as variable rates, not fixed rates. And so the majority of business for lenders comes from variable rates, and as a result, it's important that they compete with each other on variable rates. Fixed, on the other hand, to me looks like, particularly with 2 year and 3 year fixed rates, looks like it has been used to retain business. When clients are looking at getting a better deal by changing lenders are able to offer them a nice cheap 2 or 3 year fixed rate to retain their business. And so in a market where there's been a lot of refinancing going on, I've been seeing fixed rates retaining customers at their existing lender. If you already have a loan, now would be a good time to look at fixing. If you don't have a loan but you're thinking of buying a house, then that's a separate conversation, because the most important thing from my perspective is figuring out which lenders are going to lend you the money to begin with, and then once you know which lenders are going to lend you the money, then looking at the lending options that exist with those lenders. And at a particular lender, the better deal might be a variable rate or it might be a fixed rate. So that's going to impact your decision as well. And that's where a conversation with a mortgage broker comes in. We deal with these lenders all the time. We understand the history of their rates, how often they tend to change, and how that's likely to impact your situation. So if you'd like to talk about this more, just make an appointment with me. Thanks.